for 3 minutes on the markets. Mark, good morning to you. So let's start with the impact of shutdown, and in particular on the US dollar. I see Citi talking about how this is something that's going to weigh on the dollar. And I think from reading your notes, you think that that's a sort of path of least resistance for the dollar right now.
Absolutely. I think that's probably the easiest way to kind of play this kind of theme. I think overall what government shutdown means is not major economic impact unless it extends. And obviously we don't know how long it extends until we see it play out. The assumption is it'll only last a short period of time and then we'll move on from it, which means that the underlying trends continue because we generally get not only kind of a delay of some data, but we get, suspicion of the data that we do get. So that would mean positive for equities, probably a little bit negative for bonds, which counteracts the positive for equities. So therefore, they're kind of, volatile but go nowhere. You keep the same trends. The one thing it probably does help, though, is dollar weakness. Now, it's interesting here in this context that last week we expected a dollar bid at the end of the week in terms of month-end corporate rebalancing flow. FX is a T+2 market, so the main day for that buying was going into the Friday fixes. We saw that flow go into last week, and immediately then the dollar weakened again this week, which shows the underlying bias there is still to slowly reduce those long-term exposures to the dollar. And I think that is the path of least resistance, is a slightly weaker dollar over the coming days and weeks.
Mark, do you think there's a risk to markets that they put too much emphasis on the ADP number this week, in the absence of jobless claims and NFP, that perhaps the direction of the Fed is set by ADP? Does that concern you?
I think you're absolutely right that to suggest that there's a risk that we'll get, a little bit of an overreaction to the data points that we will get. It's all that people can work off, and we're going to have a little bit of people hesitancy about how to react, and then we're going to have other people who don't normally look at these data as much suddenly focusing much more. You have a lot of the market who just kind of wait for the NFP, that's what got into their models, and suddenly they're going to go, oh, we don't have that. We better, put too much weight on ADP. So yes, there's probably a chance for overreaction in the short term. I expect more very kind of short-term interim volatility as a result during the shutdown period, but I don't think it goes into new trends.
Mark, earlier this month, we hit an intraday low of 398 on the U.S. 10-year. From here, how low do yields go?
I don't think they go any lower than that again. I'm going to remind of the important context here, Kriti, that I got US yields wrong over the last couple of months. I was the person who, having been bullish treasuries earlier this year, turned bearish early August, which was clearly poor timing because then they had a nice rally after that. I think that now that the Fed is out of the way, I don't see any particular reason for treasuries to strengthen massively. Now, of course, you're going to say, but isn't shutdown mean treasury buying? Absolutely in the short term. So we'll get yields maybe drift a little bit lower in concern. Do they break 3.98? I'm not convinced. I probably see more topside risk than downside risk in yields.